Welcome to the Market Huddle Plus. I'm Kevin Muir, and we have the great pleasure to welcome back to the show Peter Haynes, Managing Director of Index and Market Structure Research. We brought him back to talk about two timely issues in the index community. Peter, God, I'm mistaking you for Patrick already, Peter. Peter, it's great to have you back on the show, buddy.
I thought you didn't start drinking beer till later in the day, Kevin.
You're absolutely right. And for those who don't know, Peter was on our show, what was it, a year ago? And we go way back. I think Peter was the competition that I always used to talk about when I was at RBC in terms of coming up with the actual really important research and stuff like that. While I was just trading, you were actually doing some real, true value added stuff.
Yeah, well, Kevin, we always used to be frustrated that we would do the research and you would get the trades. So I'm kind of glad. I'm glad you retired to the pod world and the hedge fund world. So I appreciate the fact that we don't have to compete with you anymore.
It's funny. All right, so let's talk a little bit about index rebalances, because there's since our day, or you're still in the business, but I'm no longer in the business of index rebalance, but the world's really changed in terms of these pre-positioning and people betting on stocks coming in and out of the index. And there was recently kind of a Bloomberg article that highlighted one of the pod shops had lost $900 million betting on these index adds and deletes. You wrote about that in one of your recent pieces. Give us some color there. What happened? What's the business like? And is this a problem?
Well, I don't think it's a problem, but I would say, Kevin, the business has changed a lot since the days when you were actually in the chair managing index rebalancings for clients and trading around these events. And what really it was interesting, Kevin, because this week is the 35th anniversary of the first ever ETF, which, as you know, came from Canada. I was fortunate enough to be part of the Toronto Stock Exchange group that formed the TIPS, which came out in 1990. And I did a presentation this week to a group of ETF issuers on the history of that. And I ended with a couple of warning shots or concerns I had, one of which was one of the greatest features of the ETF is that the ability to always trade at net asset value, because you can always create new units. But the bug associated with that is that some of these bespoke funds that are based on certain styles have gotten too big and you can't stop it. And then when those underlying indices rebalance, the rebalancing activity is massive. And we used to say, okay, if a hedge fund's going to trade ahead of XYZ index rebalance and they lose money, too bad. See you later. You're just getting in the way of the indexers. The truth of the matter is the large index funds understand that the hedge fund pods and other index traders are part of the ecosystem. They're needed on these massive rebalancings and should be considered as part of the process. So the anger towards that group has gone away completely. And of course, lots of different hedge funds have pods that are what we'll call index arb or index rebalancing or part of their central risk books. And as you point out, there was a high profile Bloomberg and the Wall Street Journal story this week about some supposed losses. And so the question then is, why did the hedge funds that were pre-positioning ahead of index events lose money? And it happens. It's a confluence of events. Back in 2022, when the Russell was doing its annual revision, as it always does in June, the names in the portfolio went the wrong way. Hedge funds were long or short, depending on what was happening, and they got hurt. And that was pretty well celebrated. And we saw a kind of a pullback for a period of time in the capital provision from the hedge funds. They recovered, and they do well longer term. But then they ran into another hiccup here in February. 3 main events that we know of in North America. There's more, but 3 that we know hurt them. Number one is they like to try to guess what's the next name going in the S&P 500. And each quarter, S&P tends to look at rebalancing the index, and you tend to think it's going to be the bigger names that go in. So what the hedge funds will do, and you remember this from your day, Kevin, is they'll buy 3 or 4 of the top candidates, and then they'll look at the exposure that they have, and they will hedge that with other instruments that would at least get rid of the so-called beta risk. So they're sitting there looking at an individual name. And so the top name on the candidate list in 2025 March was AppLovin. Well, what happened to AppLovin a couple of weeks ago? There was a short report that suggested there was accounting issues or something like that, and stock fell by 20%. So even if you had a hedge on, that idiosyncratic move on that one name was probably enough to cause losses. and
Okay.
unwind a position into a weak market. So that's issue number one. The other two issues are what I consider really interesting. And the first one relates to a NASDAQ dividend index and the Rising Dividend Achievers Index, I believe it's called. And First Trust has an ETF that has about $13 billion on this index, based on this index. This is a great example of the feature becoming a bug. This fund got too big. And so when these funds get too big, they'll often go back to the index provider and say, we need to think about how the rules look for this index. Like
Right.
maybe you can broaden it out or just treat it a little bit differently so that our positions, we can be spread out over more risk. And so, sure enough, in the middle of February, NASDAQ, the index provider, announced that they were going to change this benchmark. And it went from having a basket of, first thing it did was it went from changing the universe of eligible stocks to reduce the eligibility of smaller names.
Okay.
Because at the end of the day, it's an equal weight basket. You have
Oh, gosh.
$13 billion invested in 50 names at an equal weight. It's fine if you've got $250 million of Apple, but it's not fine if you've got $250 or $300 million of a smaller cap security. So
Right.
first things first, they reduced the universe. And then
Okay.
secondly, what they did is they changed the rules. They said instead of it happening all in March, it's going to be spread out over the year, and it's going to go from 50 names to potentially 200 names. And so this, what I don't think NASDAQ would have appreciated, there was no consultation, they just put the rule change out, was that the hedge funds that we talked about tend to position on these types of rebalancings well in advance. And in this case, in advance of the index rule change. So they're working, they're driving down a road, assuming that something's going to happen on March 21st. And then they got a fork in the road and they have to go down one path and the index goes down another path and they lose money. So that one would have hurt. And then the
See,
third
this is,
one,
can I just, before you explain
Sure.
the third one, I just want to interject here because this is the part that I found most amazing about your report is that, yes, I understand that when you're a hedge fund, you're sitting there, you're betting on what's coming in and out of the 500 or what's going into the Russell, the S&P 600 or the Russell 2000. But I guess the part that really surprised me the most was these one-off ETFs that have rules that aren't really the same as the S&P Index Committee rule, which is very well thought out, very, it's steeped in a lot of tradition. You can probably game that a lot easier. You have these kind of very popular products that have kind of arbitrary rules. And I was shocked by the fact that there was this much gaming going on and that these products have become so big. It's almost like the tail wagging the dog.
Absolutely. Kevin, FTSE, MSCI, S&P, the big three. Yeah. You can have a company that is deemed to be in 3 different countries by each of those providers because of their rules. There's no consistency whatsoever, and it becomes a really complicated game to pay attention to. And the hedge fund pods have the smartest minds following these things very closely, paying all the licensing fees associated with getting all the data necessary to figure out what's going to happen. And we all know the definition of a good index is it needs to be able to be replicated and the rules need to be transparent. And I think this is where we're starting to run into a little bit of difficulty, has to do with sort of transparency of rules and being able to properly predict these changes in advance.
Right. All right. So tell me the third one, because there was also a third accident that you highlighted.
Yeah, this one is strange in that it is related to a smaller underlying fund. S&P's small cap index, you've referenced that a couple of times, was the universe for an ETF run by an ETF provider called Pacer ETFs. And the symbol of this small cap ETF is CAF, C-A-L-F. There's also a large cap one called COW, not surprisingly. And the CAF, again, had historically 100 names in it. And S&P put out a proposal in mid-February, a consultation, but oftentimes when the consultation comes out, it tells you something's going to happen. And the consultation came out in mid-February, and then it had to do with changing the benchmark, going from 100 to 200 names, and changing the universe of, and again, it has to do, there's screens around cash flows and other different things. The universe went from the S&P 600, which you referenced earlier, to something that I'd never heard of called the S&P United States Small Cap Index, where it is difficult to get the information on exactly how that index is constructed or then to try to replicate what's going to happen going forward. But nonetheless, this ETF has something like $5.5 billion in assets under management. Yeah. It was previously 100 names. It's now 200 names. And if you were, and the rules have changed completely, So if you were predicting in advance what was going to happen to this benchmark, and you just assumed that that would happen in March, and then all of a sudden there's a head fake and there's a rule change, something like a 60% one way, like it's literally 3 billion by 3 billion on the rebalance, Kevin, in March. Like you go from an old portfolio to a new portfolio because there's a new index as the underlying, and next thing you know, there's a $3 billion two-way trade going on in the market that has potential impact because some of those names aren't that liquid.
It's just shocking. And, you mentioned that there was a Canadian one as well that also hurt the index. It was almost like a perfect storm, like George Clooney should be getting together with Mark Wahlberg in trading index, because that's what it feels like here.
Yeah, this one was about a year ago. We have a small cap silver fund, SILJ. It's actually a U.S. fund, but most of the underlying securities are Canadian because obviously it's mining sector. And there was an ETF provider by the name of Amplify, which took over from another ETF provider, a fund, and they decided to change the benchmark from the old index to one run by NASDAQ. And so that was in the merger documents of the two ETF providers. But what was not in that document was what would happen with the new index and when it would happen. And so literally, Kevin, you love this. You're sitting at your desk at 3:50 p.m. and the TSX announces the market on close imbalances, which come every day and tell us what demand or supply on individual stocks will take place at the close. And all of a sudden, we're looking at like 500% of daily volume for $250 million silver companies that are rebalanced, and nobody knew what was going on. A whole bunch of stocks went in, didn't close properly, went into extension. Ultimately, the trade caused stocks to move materially both ways. And it turns out that rebalancing was entirely put into the market on close facility, which is the antithesis of best execution for a trade of that size. But I'm warning our traditional customers we talk to that these types of events will continue to happen. And I'll highlight one more. Early last year, there was a dividend rebalancing on an S&P index. And S&P announced on Friday night, the names that would go into the new portfolio.
Yeah.
But the market had predicted in advance of that what would happen. And the predicted list was different than S&P's list. So people called up S&P and said, your list is different than ours. And they said, yeah, our list is right. And they said, no, I think you're wrong. Please take a look. And 2 days later, S&P came out with a revised list, which was similar to the hedge funds that had pre-positioned or were in position. But meanwhile, all of the names that weren't on the that people thought were supposed to go in based on the announcement, which was wrong, all behaved in a certain way. The names that we thought were going to go in were unwound. And so the fundamental community is calling up and say, hey, Peter, you're the index guy. What are you doing out there? And what do you mean? And then they're basically saying it's my fault. But really what had happened was because the street was predicting what was going to happen and it changed and then changed back. All the traders were repositioning for that. And it created a huge amount of noise in large cap names. This is here to stay, Kevin. And
Peter, your sell side, of course, it's your fault. Who else is the buy side going to yell at?
Yeah, that's true.
All right, so let's just talk a little bit. So these pods get tagged for almost $1 billion. That to me is the other part that's just kind of amazing is the size of it. And I'm just trying to look through. I can't find it, but one of my trading communities, there was someone overseas, and you've highlighted some American examples, and there's also a Canadian example where these guys got tagged on expecting Fairfax to be put in, and it ended up being another. But there was other examples. I think that it's actually there was a couple in India. There was something in China. So this is really a global trade, and that's why I guess it's kind of why they were able to lose $900 million. Because when I think about the opportunity set, it feels like they're almost too big for the market, that strategy. And I was just kind of wondering, is this just the ebbs and flows of a strategy, meaning it does well, capital's attracted until the point where the returns go down, and then all of a sudden people get tagged and they leave, and then the strategy widens out again in terms of people are attracted back to it? Because I think, if I'm not correct, there was one pod shop that got hurt. There was some pain in 2022, and I think one of the pod shops left the business and has never come back. Could you talk a little bit about the ebbs and flows of the expected returns of the strategy? And do you have any sense of how good the strategy is? Like, have you ever spoken to the guys that do this?
Well, you've seen some of the stats published by the hedge fund community around their multi-strats, which this would just be one sleeve of, or the
Right.
individual index rebalancing. And I think the strategy's obviously attracted a lot of capital, and we know that capital is going to chase where the returns are available. And Kevin, I would say that this is just the ebbs and flows. Absolutely. Now, you mentioned a number which has been put in the press. I have absolutely no idea if that number has any merit to it, whether it's bigger or lower. But the press is certainly picking up on and sensationalizing a large number. But Kevin, I would go back to its ebbs and flows. It does
Yeah.
seem, and I agree with you, Kevin. The number seems very large, and it's kind of unfathomable. But the reality is that it is ebbs and flows. It's positions plus leverage, deleverage, unwind, have things wrong, get surprises, and next thing you know, you're on the wrong side of this. So I view it totally as ebbs and flows, and just part of the business.
Okay. All right. The other thing that got you back for is to talk a little bit about the Russell 1000 growth rebalance. And this was a fascinating topic. And again, you were way ahead of everybody on this. I think you were talking about it last summer when nobody else was. And when I kind of finally figured it out and clued in, I reached out to you and you were very kind to share your research and what was expected to happen. I would love for you just to kind of walk us through what people were worried about. I guess the worry really started to intensify at the end of last year with the concentration in the Russell, in the various index of the Mag 7. Talk about the problem that indexers are facing and what they did about it, and then how it eventually played out in the ensuing months.
Yeah, this is a made in USA issue. We're dealing with the Russell, which is one of the primary domestic benchmarks in the United States. The Russell 3000, typically broken into large cap 1000, small cap 2000. Annual revision in June of each year. That'll go to twice a year starting in 26. So when you break down Russell, it goes into its component parts, and very popular are style indices based on either the growth or the value portion. So Russell has a whole bunch of style indices. And in some cases, for the large cap growth side, the biggest names in those portfolios were becoming very concentrated, not surprisingly, because they're Mag 6 names. And so the worry and the rule is that, and it's a rule that is basically a hard and fast, draw the red line, is that each quarter end, if you're a fund manager in the US, you cannot hold any individual name representing more than 25% of the portfolio. And any name that equals 5%, if you add them all together, they cannot be more than 50% of the portfolio. Those are so-called diversification or RIC rules in the US. Those are red line issues. And so the index, the Russell 1 growth, turns out, is a very, very popular benchmark for the active community to use to judge their performance. Now, the active community is going to pay attention to their benchmark. So if their benchmark has 10% in Apple, chances are they're not going to have 0 in Apple. They're going to have an active bet, as we'll call it. If they don't like Apple, they might hold 5%. If they really like Apple, they might hold 15%. They're not going to hold 0 when it's that big. And so what happened was we got to a very close to the limit of concentration, and Russell realized they needed to do something with their rules. And so they put a consultation out on creating a rule that says that any stock that's 4.5% or more, if they add up together to more than 45% of the index, then anything over that will be capped back to 45. And that event is on March 21. It is set based on the prices that were last Wednesday, the 12th, I believe. And so going into effect on the 21st. And why we were watching this so closely is if it's a really big capping event and Apple's weighting, say, fell by 2 or 3%, that was going to result in fundamental investors having to pay attention in their portfolios. We estimate there's more than $1 trillion benchmarked by the active community to the Russell 1000 growth alone. And then there's other Russell growth indices that matter, but that's the primary one. And then there's $400 billion in straight indexed assets linked to that benchmark. So add it all up, and you're talking about a big potential change if there's big deviations in the weightings. As it turns out, that capped group is worked out to 45.89%. So on March 21, we need to lower the weightings of those big names just a little bit from 45.89 till they equal 45. But the strange thing about, again, we're coming back to these quirky rules. The way that this benchmark is structured is it only keeps the names in the capped group that add up to 45%. Everything under that is in another group. Well, it turns out there's another stock in that other group called Meta, which is 5.1%, but it's not in the cap group. Next quarter, it could be in the cap group, and it could make the rebalancing massive. And then again, the fundamental community will care. So we call these like up and down events, the edge cases, we'll call them cliff index events, where you have these massive rebalancings because of quirky index rules that happened last year with S&P. And there was a big Apple Nvidia trade, $10 billion each way because of a quirky index rule.
Right. That's in the XLK, right? That's exactly. The Spider Select.
Yes, that's exactly. Well, what did S&P do when they saw that happen? Because it was going to reverse 3 months later, changed the rules, made it proportional. And that's what Russell needs to do. And I'm telling you, Russell's heard it from the street. These rules are crazy, and you're setting yourself up for a so-called cliff index event with big flows unnecessarily, and they need to change the rules. So I'm sure they've heard that from the street. We've certainly echoed that opinion and written it in our research. And so stay tuned on that one, Kevin. But once again, who would have thought Russell 1000 growth? When you reached out to me on that, I'd heard from some fundamental guys, and I realized that this is the most followed index event from the fundamental community that I've seen in a long time. People were really, really paying attention to this particular event, and it really got my attention, particularly from the fundamental community.
The other thing that's interesting about that is that when we originally started talking about it, the market was much more concentrated, and the initial estimates that you had in terms of the amount of selling that were going to go on were quite large. Like it was going to be billions of dollars of Mag 7 that needed to be for sale. And what I think is most interesting about it is I almost wonder if the Russell announcement was part of the reason that the Mag 7 sold off. People, fundamentals investors, all of a sudden looked around and said, hey, wait, these markets are getting way too concentrated, and I am running the risk and the danger of this actually being kind of like a too concentrated moment, and fiduciaries and other people and risk managers are going to tell me that I can't own this much. And it was almost like a wake-up call for the benefit of diversification again, because it was kind of shocking to me that the people weren't more scared about this.
Well, Kevin, growing up in the Canadian market, we've always heard about how concentrated our market is between banks and materials. Everyone says point to the U.S. Well, the U.S. has been historically the most diversified market,
right,
until now. And in fact, if you look at the large names, it's been forever since we've seen this many names concentrated at the top of the benchmark. Shout out to S&P for creating an S&P 500 index that caps any individual weighting at 3%. I like that idea because it tends to be somewhere between this notion of an equal weight, which people want to point to. I just showed you a second ago, or talked a second ago, about a really big equal weighted portfolio that can't invest in the smaller names because the positions are too big. And everyone who points out S&P 500 equal weight, look at the performance, it's great. Understand that they can't scale that portfolio
right
up. We hear that all the time, and people always forget that. So, I think these events are here to stay, Kevin. And concentration in the U.S. You're right; it's been a lightning rod issue. But once again, if you're a fundamental investor running a portfolio with that as your benchmark, you still can't own zero. It's like Nortel back in the 2000s. You got in the early 2000s. How many portfolio managers that you used to talk to ended up getting fired because they hated Nortel, but the performance was so bad that they ended up being Nortel was around longer than they were able to stay liquid, as Haynes would say.
So for those who don't know the story, Nortel was a very big component of the Canadian index, to the point wasn't it, what was it, 40% of our index, one stock?
35% of the composite index in July of 2000, if I remember correctly.
Okay, and the other part about it was that Bell Canada owned a whole bunch of Nortel, and it was trading at a Palm Triple M situation where it was trading below the intrinsic value of their Nortel holdings. So between the two of them, you were almost 50% Nortel on the index. It was absolutely insane. And the part that I love the best about that story is that the TSX finally created a capped index, which everyone obviously moved to, but it was just in time for Nortel to start going down. It was the top. And at the time when Russell announced this, I said, this is going to be just like the situation in Canada, where by the time the indexers figure it out that the index has become too concentrated, you want to be getting rid of that exposure because it's the top.
Kevin, I'm glad you brought up that capped index in Canada. What's different about the Russell event from back then, really important difference, is in the case of Russell, the new benchmark going forward, the continuity benchmark is
Right.
the one with the caps in it. Whereas back in Canada in early 2000s, the continuation benchmark was the composite. You had to physically change your benchmark to the capped index and go through that whole process, which can be difficult. And I think at least half of the community moved. But what's really interesting, those two indices today, the composite and the cap composite, are exactly the same because no names over 10%. But go back and look at the historical performance of the two indices, and it's dramatically different.
Right. Just one last thing on this note. Goldman Sachs has a great chart that I love to reference where they talk about the concentration levels in the U.S. and they have it going back 100 years. And you look at it, it's 1929, like the other periods of peak concentration were 1929, 1972, 2000. They were always terrible times to own the stock market as a whole. All right, before we leave you, you in your piece, you referenced a book, and I was like, I haven't heard this book in ages. And it was a book called Ugly Americans, and it was about a bunch of traders that actually went into Japan in the 80s and basically enjoyed the bull market that was happening there. And one of my pals, Grant Williams, when I got a chance to meet him personally, I was like, okay, you're like perfect in terms of your timeline, matches up with the Ugly American guys. Do you know all these guys? He goes, oh yeah, I know them all. It was a great story and stuff like that. But all I remember from them is the only story I remember from that book was them buying Ducati motorcycles and zipping around Tokyo like idiots. But you have a story where you said there was some big index rebalance that occurred then. Could you give us just kind of your recollection of that story?
Yeah, well, I'll tie it into something that concerns me today, and that is, I think, the lack of oversight of the index providers. And I'm not criticizing them for being untoward. I'm just saying that the amount of information that they control and the materiality of the impact of their decisions is something that I think warrants more scrutiny from North American regulators or some regulation in Europe. But you take back to the story that Ben Mesrich, who wrote the book, told around the Japanese benchmark back in, again, when we were starting our careers out, Kevin. The Nikkei, it took 30 years to get back to where it was in 1990. Yeah. And so sure enough, we have the Nikkei 225, which is itself a price weighted index, kind of like the Dow. But there was it was being run by the newspaper, the local newspaper. And so what Ben Mesrich tells in that story is that one of the traders found out from someone they knew, I think, if I remember correctly, someone they knew at the newspaper, that the Nikkei was about to change its benchmark and add a whole bunch of high-flying tech names. Okay. And so they knew that was going to happen. And they, of course, went out and positioned their portfolios and made hundreds of millions of dollars. So they stay in the book. Who knows what they really made? But the point was they got access to information the rest of the market didn't have. They traded on it. Hence the name of the book, I think, Ugly Americans, and the motorcycle story you had, and all the other things that Ben Mesrich talked about in that compilation of stories. And so, there's an example of getting the information. And there has been some speculation, I should say, to tie it back to these recent changes, at least in the case of the CAF, the hedge fund community started to notice those portfolios moving before it was made public. And that's always a warning sign. So whether or not there was anything untoward, who knows? But it definitely gets your radar up. Why is this basket moving in the wrong direction right now? And then 2 weeks later, there's an index announcement. So yeah, it's just something that's been going on since Ben Mesrich wrote about that early 90s story. But it's even more important today, given the amount of assets that are benchmarked to various bespoke benchmarks. We can't keep up with it. Who's kidding who can?
Yeah. Great stuff. Peter, thank you very much for coming. Why don't you tell people, and I guess you're purely institutional, but for the institutional folks that are wanting to learn more about your research, and it's US, it's Canada, it's everything. If you're interested in index stuff, make sure you get your put onto Peter's list. Where can they reach you?
Peter.Haynes, Haynes, at tdsecurities.com. And happy to chat with anyone. We did the merger with Cowen a couple of years ago. I've been at TD for 30 years, and more recently with our partners at TD Cowen in the US, and we've become a lot more global in our scope now, and that's been an exciting change for our organization. So happy to chat with anyone.
Thanks again, Peter. And as a fellow Canadian, elbows up, buddy.
Elbows up, exactly. Thank you.
Take care.